thank you all for coming. Like I said, I know it's hard to kind of get everyone's schedule, especially this time of year, and especially on a night where it's really pretty outside. We appreciate you all coming and hearing from a bunch of people who think about legal work, investments, and taxes, and all the stuff that most people don't want to be thinking about. So thank you all for coming. Let me just do a quick introduction. So I'm Andy Reynolds, COO and Financial Advocate at Ballast. Cameron Hamilton, Director of Planning and Partner at Ballast. Jerry Psimer, owner of Psimer Associates. They do a lot of tax work, especially with dentists in the medical community. Jeff Gehring, estate planning attorney, and I want to make sure I got this right, chair of the Dickinson Wright estate planning team. There's another part of that too that I left off. What's the other half? Do you even know you're part of that?
Yeah, I do.
Yeah.
I do. That's right.
Dan Soldato, who is the co-chair of Wyatt's healthcare team and attorney, also does a lot of contracts. Just recently helped my wife do her contract. And John Boardman, our CEO and founder of Ballast. So today we just really want to make this conversational. If y'all have questions, feel free to ask and shout out any questions. We have a bunch of questions that we've kind of pre-scripted, and we're just going to all talk about it. So seriously, feel free to chime in, raise your hand, whatever. So my first question for everyone, and maybe for you three from your all side, and feel free to just kind of talk about it. So I think when someone's buying or selling a practice, we all kind of get involved. In our dream team scenario, when a client of ours is looking to buy into a practice, sell a practice, we want all of us kind of be involved and on the same team, working together on things. So as you guys think about each individual discipline and what you're thinking about in that regard, can you guys just kind of talk about what you might be advising a client on as they come to you in kind of the first few steps, or best practices, or things that just come to mind when you think about buying into a practice, selling a practice? I know there's a lot there, but just kind of some initial thoughts.
Sure. What's that?
I don't know. When can you drill down on, are you talking about buying into a practice to be a co-partner with somebody, or a 100% sale?
Let's start there. Buying. You're
you say
an associate coming in.
You have an associate that's been there a year or two, and they realize they like each other. Just real quick, 20 years ago, we still had to worry about corporate goodwill versus personal goodwill. That's kind of gone away. There's just not many C Corps left in small dental or medical practices. So you're typically a single member LLC filing a Schedule C, or an S corporation, one of the two. If there's a single owner S corp, we've become more enamored with the 3-entity approach, where we form a partnership, and then the S corp, the buyer forms his own S corp, becomes 50-50 owner, and then the other existing owner becomes the 50-50, because multi-S owners have issues with basis, and distributions have to be 50-50. And if you've got a buyer that has a loan to pay, they don't have the wherewithal to take really distributions from their profit, because they're pretty much, that's all going on W-2 for a lot of different reasons. Reasonable compensation, funding retirement, things like that. That has to be based on your W-2. So we've become more, we're moving in that direction more so, where you kind of form the partnership. One potential pitfall, we haven't seen that in Kentucky, but I've got other, Psimer Associates belongs to an organization called the Academy of Dental CPAs. So in some states like California, where things buyers, if they're participating in Delta Premier, if they form that new partnership, that's a new entity that has to get a new federal ID number. The insurance companies could renegotiate those contracts at that time. So I've had a couple of colleagues say that they spelled the whole thing out, everybody was happy and on board with it, and they had to pull out at the last minute and just go back kind of to the multi-owner S corp because the hit from the insurance companies was going to be too much. Haven't seen that in Kentucky yet, though. So we're trying to move away from any multi-owner S corporations in terms of that. From a taxability standpoint, really, for the next, maybe not at the time of the sale, but for the next 20 years or whatever the term is.
Sure. So, if a associate doctor is becoming a partner in a medical practice, the first thing I would look at would probably be the partnership agreement or whatever type of agreement that the doctor would be signing as a new partner member, whatever the case might be. Oftentimes the key issues there would be looking at the compensation first. What is what are you earning? How are you earning it? Based on productivity, are you getting any guarantee? That kind of thing, and advising on that piece. Non-compete is a big one then as well. It's become, I'm sure a lot of you have heard, the comments period just closed recently on the FTC's proposed ban on non-competes. Those are post-employment non-competes, tens of thousands of comments, including the American Hospital Association, the American Medical Association. So we have a lot coming in the next couple of years on that part of it, but for now, in Kentucky, and particularly if you're an owner of a business, still enforceable, the post-termination non-compete. So we think about that in terms of always thinking about, yeah, I'm a partner now, but what's your exit strategy, right? You always kind of have to think to that, and that's something I advise on very often, and to have an out if things ever go wrong. And so that's something I look at very, very closely with a client, and so then you've got your exit. But what does that mean for you post exit? Are you going to have to move out of the community? What happens to your practice? Because those relationships, the patients that you build up there, that's your lifeblood. So are you getting pushed out of the community? So those are a couple things I'd look at in the contract right off the bat. I think as a new member, because that will often change from your status as a early employee to now. The practice will be asking more of you, rightfully so, right? So they're going to ask you to get all in, and what does that mean from a compensation and non-compete standpoint? Would be probably two key issues I'd look at.
I was going to ask a question on that. So currently those are state specific rules.
Yes, on non-competes, yes.
Like California, as an example, requires financial consideration, is that correct, to enforce a non-compete, but Kentucky does not? I've heard sort of mixed.
If you add in Kentucky, if you like have a current agreement and you want to change the non-compete, you would have to have additional consideration. Typically, would be the rule as well, just because it's changing the nature of the arrangement, right? So you're just throwing another non-compete on top. What's the consideration for doing that? So yeah, I think in a lot of states that would be the case, but the rule I'm mentioning would be a federal rule that would blanket over. Yeah.
I think from a state planning standpoint, there's not a whole lot of unique issues if you're buying in or exiting the business necessarily. It's a life event. It's going to have financial repercussions for you, for your family, and so that's a good opportunity to look at your estate plan. If you're buying into the practice as a younger physician, maybe that's your opportunity to really get your estate plan in order and shored up. Recently, we've had a few physician clients that sold their practice to private equity, and now we've got a big liquidity event. And so with money that's now available, we're looking at sheltering that in a tax-protected, asset-protected trust or vehicle as a way to set some money aside for future wealth.
Can you elaborate a little bit on tax protector? I think there's a lot of, obviously we all work in industries that there's some liability, personal liability, professional liability. A common theme, even as people are more educated on estate planning, is still, that's for the uber wealthy. I don't need that. I have my malpractice and I'm good, or I just don't have enough, even though I have a $10 million stake. Can you just talk a little bit more about that, and then maybe also just chime in on estate planning in general, the benefits of that up and above just estate tax?
Sure. So all of us in this room do think about personal risk related to our professional responsibilities, and malpractice coverage is the best place to start. Umbrella coverage policies also provide a nice additional layer of protection. I think insurance is probably the cheapest protection that we can get. But as you begin to get financial traction, as you begin to accumulate assets, finding ways to protect those assets from a judgment creditor, from a business creditor, becomes more important. Even if you've got a few $1 million, if that's all you have, it's really important to protect. Maybe more important to protect than if you have $100 million. And so, there's some different ways that you can protect assets. And I think it's kind of a sliding scale, if you will. Some assets are protected just by virtue of the law, qualified plans, 401k, that type of thing are protected. IRAs also protected up to a certain threshold. Think about it in the context of if you had to go through bankruptcy, what would be protected by the courts. So being aware of having a large qualified plan, that money is going to be protected regardless. Putting assets into a non-physician's name. So if you have a spouse who doesn't practice, putting assets into his or her name is another kind of first step that many physicians will use to shelter or protect assets. But you have to be aware of what type of risk you're protecting and what you're leaving exposed. If you put all of your assets in your husband's name and then he divorces you, that marital risk might have been a greater risk than cutting someone on that operating table. Or we all have risk by driving around. If you go to a UK game, chances are you could run over somebody in the crosswalk. And if you put all the assets in the driver's name, then that exposes them. So that's not a perfect solution, but it's often maybe the first step we see with younger physicians. Titling your house to joint ownership provides some measure of protection, because with an innocent spouse, a creditor usually can't force a sale of the property. If you have a big house and you have a big mortgage, the bank's first in line. And so if you don't have a whole lot of equity in your house, that bank's not a very attractive asset to your creditor either. Once you kind of clear all of those hurdles, if you've got that nest egg, typically think about using an LLC to provide some protection, but I think that works best for an active business, a business that's doing something. So a trust is normally going to be your next best bet. And there's different kinds of trusts out there. There's lots of different styles of trusts. The big thing to remember is if a trust is revocable, meaning you can get the assets back or you can unwind the trust, then a creditor can probably get a court to unwind the trust as well. But if the trust is irrevocable, meaning it can't be easily changed or amended, and you've given up some access to what you put in the trust, and you've given up control over what's in the trust, then a court should respect those parameters and prevent a creditor from getting to those assets. So if you think about if you sold a piece of property or you sold your practice and you've got a nice nest egg, taking some of that nest egg and putting it into an irrevocable trust, that's for the benefit of spouse, for the benefit of kids, descendants, that's usually the best way to protect those funds for down the road.
Jeff, I know we worked together on some LLCs and trust. Explain the significance of a multi-member LLC versus a single member and sort of the issues and risks potentially.
Can I say one quick thing?
Yeah, please.
A lot of people, if you own your practice, it's all structured as an LLC. If you own the real estate, we always have that in a separate one.
Yeah.
Just want to pop that in.
Compartmentalizing risk, the risk that somebody falls down the stairs in your office building is different than the risk that you miss a diagnosis or something like that. So putting those in two different buckets makes a lot of sense.
And I mention that because some people just take an asset, wrap an LLC around it, and make themselves 100% owner of that LLC, and that creates some potential risks, correct?
It's better than not.
Yeah.
So if you own a piece of rental property and you're the only person that owns it, putting that into a single member LLC does provide a veil of protection. In some states, a single member LLC where you're the only owner, courts have held that veil of protection is much thinner because the one person owns it, and there's no other innocent owners. So it's probably stronger, better protection to put that rental property in an LLC that's owned by more than two people, more than one person, so that you've got innocent partners and you've got an agreement, an operating agreement that kind of creates rights and obligations between the owners, and the courts will generally respect that and not allow a creditor to kind of pierce the veil of that LLC and get at the underlying assets.
And did I hear you saying the composition of the assets could actually matter? So as portfolio assets, marketable securities, would that potentially be looked at differently than a rental property?
Yeah, I think
that has a business function.
It does. I think it depends on where the risk is originating from. So if you have a portfolio, it's not risky itself, and you run over somebody in a crosswalk and they sue you, the actual portfolio within your LLC can be protected from that outside attack. If you have an LLC that runs a rental property and somebody falls down the stairs and breaks their neck and they sue you, then they're going to sue the owner of the LLC. There, your liability exposure is really capped at the value of what's in the LLC, and it should prevent them from getting to your other personal non-business assets.
Jeff, what would you recommend for best practices on an ongoing manner? So say you own a piece of real estate, it's in an LLC, and you never do anything ever again with your LLC other than collect income. What would you recommend kind of on an ongoing basis? Just to, if you ever had to prove as this really is an entity, like what do you guys, and Dan, feel free to chime in, what do y'all recommend kind of on an ongoing basis?
Hopefully
We'll see.
We'll see.
You write yours down.
One nice thing about LLCs is they don't require those same formalities that older corporations require. So there's a little bit more flexibility. But best practices would be make sure your real estate is titled into the name of the LLC. So the LLC is actually the owner. Get a bank account in the name of the LLC. Have your tenant pay into the bank account for deposits. Use that bank account to pay out insurance and utilities or expenses of the LLC. Kind of run it like you would if you had a partner and you were being held accountable for the way the business was run, so that if there is an attack on the LLC, you can tell the court, this is a real business. We run it like a real business. We've respected the parameters of the LLC, and so court, you should also. Anything you add to that?
No, I'd say, and then also, like with regard to your filing documents, things like that, that it's all in those same names, right? That you're not, they go look at those records, that all of it matches up, absolutely.
Can I ask you a question? This happens all the time, as you know. People forget to redo with the Secretary of State, things like
Corporate
that.
formalities.
If you go inactive, do you lose that, whatever protection you might have had before?
I think that you can, if you go inactive because you failed to file an annual report, a $15 annual report.
Online in 2 minutes.
So
Yeah,
annoying.
you might get administratively dissolved,
Yep.
but you can go and basically reincarnate the LLC. You pay the Department of Revenue some back money, you pay the Secretary of State some back money, and I believe it's retroactive back to when you became defunct, administratively dissolved. So you shouldn't lose the liability protection. You also shouldn't let your LLC lapse.
I literally have a client that just emailed me yesterday.
So
We just did that in Delaware, actually, and it did retro back, it was years, and we paid, I think, the taxes for the year in which it went defunct, some sort of filing fee for going back, and then they retroed it back to that year. I believe Kentucky would follow the same concept.
Along those lines, personally, I had a client that had their entity lapse, and then somebody else came in the day after, took their entity over,
Registered it.
and registered it, so then they had to redo their entity, so it's just something to
Yep.
Okay.
That is a problem. It was a long, drawn out battle.
We're not malpractice agents or necessarily experts on this, but I want to bring Cam into this conversation just to talk a little bit about some of the issues and around malpractice insurance.
Yeah,
Sort of structures that people need to know about. Many of you probably already know about these.
Sure.
But I think
I mean, just like anything we deal with, our kind of mantra is know what you own. So from the employee side, employer side, which we need to understand how are we covered, and how does that affect us. So most of the time there's kind of occurrence coverage, claims made coverage. Hopefully nobody in this room has claims paid coverage. But we need to understand the difference. Occurrence, you're covered for if during the policy period something bad happened and a claims comes later on. So I retire here, I did something last year, someone comes back a year from now, I'm covered. Claims made is, do we have the policy right now when the claim is made? And if we don't, if we retire, then we need to have extended period coverage or by that tail. So we're getting into negotiations, or if we're changing jobs or we're bringing on associates, that needs to be thought through, especially from the employee side or someone who's buying in. We need to be thinking about this ahead of time and not be in a situation where, you know, the system is telling you, here's your one option, and we need to know in 2 days what you're going to do. Because you can get in a situation where you know, you're bound to keep your claims made coverage or vice versa. So, yeah.
So what if you bring in an associate and they weren't as educated or as aware of their options, and they have the claims made and they were told about maybe minimal advantages of occurrence of your own occupation and your specialty? Can that individual within that malpractice company switch coverage?
Yeah, a lot of times you can actually get a nose as opposed to a tail on the occurrence policy.
Let me say one. Go ahead.
Yeah.
Go ahead and finish. I don't want to cut you off.
Well, just
Finish your thought, and then I've got one.
unexpected things are bad for a deal, right? So, you know, we need to be having these discussions on both sides as far ahead as we can, so there's no $50,000 surprises if we can.
And this is actually one thing that, you know, as a new doctor is coming in to a practice, you know, becoming an employee, this is a discussion that I'll have with clients too, is, you know, what is the insurance coverage? When will you get tail from your employer at the end of the contract? Oftentimes, particularly with, you know, hospital systems or something like that, they will have, you know, a self-insured policy or something like that, and so they'll provide that tail on, you know, for a claims made policy as just a matter of course. On the other hand, I've seen a lot of contracts where, you know, if you stay a year and then you terminate, well, you're on the hook. But if you stay 2 years, we'll split it 50-50. If you're here 3 years or more, then we'll pick up the whole thing. So that could be a significant cost on the back end and something to think about for doctors in the contracting process up front. But that's one of the sort of things on my checklist when I'm going through an initial contract. What is it going to look like at the end when you need to maybe go buy tail or deal with your insurance? Whose cost is that going to be?
Yeah, I think that's a good incentive. I mean, if you negotiate out your contract and the last thing is, well, hey, if I'm here for a really long time, can you help me out a little bit? Like, I think most, what I've seen most people are.
Significant.
Sure.
Yeah.
Right.
I mean, I've seen some big bills.
Right. Right. So we talked a lot about risk management so far, the super fun stuff to talk about. One quick question, a follow-up question for Cameron. So thinking about working and maybe you're moonlighting, I think more and more physicians and dentists are moonlighting in different capacities. You know, it's not just, okay, I'm going to go work at this hospital down the road and make an extra $1,000 a month. It's, you know, new intellectually stimulating things. When you guys are working with people on that regard, do you have a preference? I already know your answer, but can you explain your preference for W-2 versus 1099? And, you know, we love the creative side of the 1099 people, but you all may have a different thought about 1099 versus W-2, and all of y'all may differ for a little bit. So any comments on that structure if you had your ideal way of looking at that?
Well, the first answer is there's rules on that.
Sure.
Are you an employee? Right. If you're an associate in a dental practice, you're a W-2 employee.
Sure.
Now, not everybody does that. And consultants say, oh, you want to be a 1099 because you can fund your own SEP and write off your CE and all those kinds of things. But again, Kentucky is kind of behind the curve on a lot of enforcement and other kinds of things. But California unemployment, bigger states unemployment audits are going after specifically defined employees, people that are being paid 1099 that should be paid W-2. And it's really costly if you get caught with that. So if you're working for somebody and they set your schedule and you're using their facility and you're seeing their patients and if you work in an office and you go there, you're an employee. Now, locum tenens or something like that, that's a whole different ballgame. You have a job that you do something on the side, a satellite kind of deal, and you shop yourself out to different places. We have lots of, especially MDs, that have extra 1099 income.
And there's a lot of unique circumstances.
Yes,
where
but
you work in that
back
capacity.
to, if you're an associate, or if you're an owner and have an associate, they're a W-2 employee. So you have to pay their payroll taxes, you have to include them in your retirement plan if they're there long enough to be involved in that. Health insurance, all those things that your other employees get. That's part of your negotiation. You need to know that on the front end. You can negotiate those kinds of things. And they say, well, but I want to write off my travel and CE. You're like, well, have your employee give you some accountable plan to have $7,000, $8,000 a year go towards that 40. They'll pay it. It's a write-off to them. Everybody's happy. It's non-taxable to you. So there's ways to follow the rules and get the same perks. And one quick thing, and I think you're going to touch on this later, for the outside 1099 people that have other revenue besides their job, you can use that extra money to fund additional retirement, which I don't still do. But that's just something that's in my head while I'm talking about it.
Yeah, and to talk about rules, with regard to W-2 versus 1099, this is more on the employer side, something the employer will be looking at, and you just need to be aware, right? There are different rules, for example, under the Stark Law and the kickback statute, which I'm sure a lot of you are familiar with, as to how you can compensate someone that's a W-2 versus the 1099, right? So you've got, essentially, there's more restrictions around the 1099. W-2, they've given a lot more flexibility to how you will be paid, and how that looks, particularly for strict liability law like Stark. And so you've got, the employer will be looking at it from that perspective, and you've got to be aware of that as the employee coming in, as to what they can and can't do in terms of compensation, the arrangement, how it's laid out, how long it has to be, fair market value is generally kind of the bedrock of all that, but different ways they can move things around, a little bit easier with an employee versus a 1099, but there are other considerations, obviously, as we just mentioned, but something to think about as you're looking at what they're offering. They may have more flexibility under a W-2 than a 1099.
And one other thing, they're not covered under workman's comp.
Yeah.
Even working, I have Class A, the hygiene's come in for a working interview, like, put them on payroll. You have a payroll service. That's what they're for. Mm-hmm. It's no more effort in your life to pay them for 1 week if that's all it turns into, or if they're there for 3 months and quit. And they're like, well, they were only working a couple days a week. I didn't know if they're going to last, so I paid them $10.99. And then they go file for unemployment, and then things can get ugly. So you just don't want to have to deal with those kinds of headaches when you don't have to.
I want to touch on one thing Cam said, know what you own. One of the questions we get a lot and really find a lot of surprises in are disability policies. We talked about malpractice, but this is a huge risk for doctors, particularly specialists. Everyone in here knows ONOC policies, what those are. Basically, you're covered for your specific specialty. So if you're a surgeon, you want to make sure you have disability coverage that covers you for your specialty as that type of surgeon. The issue with these is that a few of the carriers actually will provide that in benefit for 2 years, 3 years, and then revert back to non-ONOC policies. So if you have a ONOC policy, it is worth having someone review it. We don't write those internally. We typically will bring outside agents to do that. But it has been a surprise to some people that you may have an injury that prevents you from being a surgeon, but you could be a hospitalist, and that would allow you to still work, and they're not going to pay that policy because of it. At the same time, group disability, so if you work for a large employer hospital, they typically have caps on those benefits. So if you're a very high paid physician, dentist, you may have a cap on what that benefit can be. You may have to get supplementary coverage up and above that to satisfy what your lifestyle is. And then the other big surprise, and I've dealt with this with a client who had a disability claim when he was 65 years old. The practice had deducted the premiums over the life of the policy premium payment period. The entire benefit was taxable for the remainder of his lifetime. So, and I'll let Jerry kind of maybe touch on how that needs to be generally handled.
We just don't see that anymore because all of our practice owners are S corps, and those are not taxable anyway. They pass through. Yeah. So, the old C corps, and there used to be the game where people would pay it personally, and then the following year reimburse themselves for it from the C corp and deduct it.
Right.
And we had a couple cases where it passed. It went through. But it's just not without C corps and small practices anymore. It's not an issue.
Yeah.
You can't deduct it anyway.
Yeah.
So have you all had clients where the ONOC reverted and they weren't made aware it wasn't disclosed?
Well, we found out the policy reverted. Fortunately, we have not had anybody actually be on a claim when they discovered that. So,
Seems like that would be fraudulent for them not to know.
It's clearly disclosed in the 150-page policy. So, very obvious to everyone who owns that. But just be aware, it does exist, and you can see why the insurance company want to add that clause in there. So. We're agnostic to which carrier people use because that's not our specialty, but we do want to make sure you have the policy that matches what you need.
Would the excuse me, would the insurance agent know this information and not disclose it to you?
Sure. I mean, I don't know that, but I'm sure it does happen. There are a few carriers I'm aware of that do that, that have that reversion, whatever inside of that, and typically this is from us. So,
One last thing on that is just making sure we keep it updated, especially as our earnings are growing. A lot of them will have, guaranteed future purchases where if we can go back and improve income, we can get a bigger benefit. But if you're ramping up, we want to keep an eye on that.
Yeah, and we a lot of conversations with doctors, dentists about the cost of disability. It's expensive, and as your income goes up, it goes up. As you age, it goes up. So it is expensive, but there is a reason. I mean, outside of your health insurance coverage, it's likely the most likely to have a claim. So it doesn't have to be permanent disability. It could be a surgery that you had to have that keeps you on the shelf for a while. It could be you injure hand cooking something for Thanksgiving. I mean, things happen that are minor that can still shelf you for a bit and prevent you from earning a living. So happy to have that conversation. There's a lot of nuance there, and we've done a number of policy reviews with people, and we also have outside experts.
And a lot of those COLA adjustments, if you don't take it 1 year, you lose that benefit as well. So that's something to be aware of. We had a client who missed their cost of living adjustment, just didn't want to increase it that year. Their income only went up a little bit. And fortunately, we were able to go back and get the insurance company to retroactive it. But it would have otherwise been taken off. They would have had to apply to get increasing insurance. So all those things are important. And another professional we could have had up here was someone who, we're well versed on this, but yeah, we're out of schools. At least Kim and I said it. So Cam, kind of going back to the 1099. So let's say you're a small business owner. Let's say you're 1099 not employee. What opportunities can we do that, outside of the stereotypical 401ks and whatnot? What fun opportunities can we do from a savings standpoint and working with, a tax person in coordination with that? What opportunities have we worked on recently for those types of people?
I'm just thinking about you are in charge of your whole financial future. So we want to be managing a diversified balance sheet, and that includes tax diversification. And so, used to be classic retirement planning. Let's go find a hospital, work for them until we're in our 60s, max out retirement plans. It's all there pre-tax. And we wind up in a high tax bracket. So for us, it's about looking at that situation that we don't want to necessarily be in, or we have some great clients who've worked into their 70s and had required distributions forced out of retirement plans that were bigger than they ever earned as an employed person, and say, okay, that's not the ideal situation, so let's think backwards. We can create our own retirement plans. If we have a spouse that can reasonably get involved, we can get with them too. We can do Roth savings up to the limits. We also want to be saving outside of retirement planning and building up a taxable bucket for early retirement. But then, as we get into, if we're really in charge and we're really earning some money, get into more kind of exotic planning with cash balance on top of the retirement plan too, where we can, if we're talking about a couple spouses, doing $60,000 into a retirement plan versus a cash balance, doing $100,000 plus pre-tax money that we can kind of put into a retirement plan, let it grow tax deferred, and hopefully get it out into a lower bucket. That's something we're interested in.
And I think one fun case studies to look at and whatnot are using that cash balance money to fund a buyout. Maybe and it all depends on your census, but if you have an older dentist that you're buying out, younger dentists coming in, using that to be worked into the negotiation of how you purchase out that physician or dentist who's leaving, and potentially giving them more retirement credits, all aboard through the cash balance formulas. But using that has been
it's really flexible, and we can design it to achieve whatever goal we have. But one thing that's great from the perspective of the older owner is we can, have the actuaries age tested to where the person who's closer to retirement gets a lot bigger contribution, and then you're saying it can be an understanding between you and the department that basically I'm earning you out. But we can also design it to favor one partner over another or help another class of employees. What we're looking at from our perspective is the planner saying, is this something we should do? Is we want to make sure it's efficient. So I don't know if you have a number, but I like, I want to see 80% of the dollars that we're putting in this plan go into owners. If it's more than that, then it's something we really need to consider.
It's usually 90 or more.
Yeah.
Especially if they're already funding 401k.
Right.
Match. Just something real quick, going back to the associate question first. Let's say you bring an associate for a 3-year associateship. They're going to qualify for the retirement plan at some point. The actuaries can pull the associate out as a non-owner doctor and only allocate like 2.5% of their pay. So it's not real costly. And again, you can kind of talk about that on the front end. Hey, you're going to be in the retirement here in 2 years. I'm going to take you from 30% of production to 32%, and I'm going to give you this piece too. And then if you buy in, then you'll kind of fund it out of your own bucket.
It's a nice tool to have.
Oh,
especially in today's
it's one
environment.
for small businesses.
Yeah.
It's about the best thing to do.
And what is that 5-year commitment now? Is that more or less
It's
the
not economic conditions.
continue showing now? Yeah. Yeah, I mean,
We,
that's.
we want to plan on having the cash flow to.
Yeah, I agree with that.
It's a
It's a
several
commitment.
years, but you can turn it off.
Yeah.
Yeah.
And we had a couple of accounts after COVID that had to do that.
Yeah.
And there was no minimum funding when we terminated.
Cam made a point about, looking at the life cycle of a client and, not talking about our distinguished CPA here, but we have found that a number of CPAs are 100% concerned about this year's tax bill. They don't like calling their clients saying, $5,000 or $10,000, $50,000. And that is important. And I think Jerry's in this here too, we like to make sure that we're minimizing taxes over the life cycle for the client. So there are circumstances, Roth conversions, various things that could trigger additional tax liability this year, but in the long run could be massively beneficial to some situation. And so I would just encourage you, as you're thinking about tax planning, don't necessarily focus on this tax bill, but really think about really the long-term impact of it.
Another one that you mentioned today is reasonable comp, and if we're not paying ourselves anything, we're also not earning Social Security.
You're not getting Social Security, which if something happens to you, you have young kids.
Yeah.
They won't be able to draw.
And if our spouse isn't working.
Yes, it's disastrous.
Yeah.
And you can only fund on your W-2 earnings, on your 401k and your matching and all that. So, yeah, a lot of people like to play that S corporation 5 game and show you how much they're saving in taxes, but it's a really bad idea. We took over a client, we actually did the valuation of the practice. We'd never worked with this person, they were in their 60s. S corporation, they were bringing home $40,000 from W-2, pay one at about $200.
Right.
This guy thought his CPA had just done him so well. He could only fund a simple his whole career, and his Social Security was minuscule.
Yeah.
And here he is, 65. He's got no nest egg hardly, and he didn't take those tax savings and use them. So it was, things are in place the way they are for a reason.
Yeah.
And, that's
one thing that I found interesting, just to peel behind the curtain on our planning software, is even though if we look back a couple years, if someone had a bad year and the portfolio is less, the stock projections a lot of times have them better off because the bump we got from the cost of living on Social Security, the present value of that is so great that it actually outdoes a bad year in the stock market. It just shows that if you're not funding Social Security, if you're not paying yourself at least, $80,000, if not up to $140,000 and maxing out for Social Security, we need to do some math.
I mean, people discount the significance of Social Security, but I mean, we have clients today getting max benefits, both spouses, and we're talking
60, 70,
$7,000 a month that they're bringing in.
And I think
and your
where
health
that-
insurance gets paid for.
That's right. Where that's so valuable is in that kind of like, you need this amount to live, to sustain, and then even for large income people, then that extra part on top is fine.
Absolutely.
And you paid into that.
Right.
You deserve it.
Yeah.
Right.
So, question for you guys. So, you were mentioning about tax savings, and I know, let's just say you sell a portion of the practice or all the practice, get $1 million taxable gain, let's say. With real estate, you do a 1031 exchange. Is there a vehicle similar to that from practice to something
The
else?
Trump tax, you used to be able, you could take the equipment, the tangible property, and 1031 it, but the Trump Tax Act cut all 1031s out except for real estate.
Gotcha.
Does that retroactive that? 25, does that go back when the?
I guess so. I guess right now, if we go back to the old rules, if the cuts aren't extended or some new packages have passed. So, yeah, that, as of now, those would sunset in 25.
Jeff, I wanted to ask you, kind of pivot a little bit. We mentioned estate planning, sort of structures, trust, things like that. But, you know, for those in the room who maybe have not done their estate plan or thinking about doing an estate plan, just talk a little bit about just sort of the fundamentals that you like to. If you've got, you know, successful couple comes in, they've got a kid or two, and, you know, where do you start with them and try to take them? So at a basic, you know, level. You know.
So just for the benefit of everybody in the room, there's an estate tax that the IRS, Congress imposes. It's a threshold if you have assets above that amount, potentially subject to estate tax and death. It's a really high amount. Right now it's 12.9 million, scheduled to be reduced in a couple of years. And so sometimes you will have clients say, well, if I don't have 13 million bucks, do I really need to do estate planning? And the answer is, of course, yes, right? Estate planning is more about putting together a game plan. It's about being intentional about how you want your assets distributed, who you want them distributed to, who you want to be making decisions for you and your family if you're not here to do that. So basic estate planning doesn't have to be particularly expensive. Everybody needs a will. Designates who's going to be the guardian for your minor kids if you pass away before they're 18. Designates an executor to wrap up your financial affairs, pay off your debts, distribute your assets to your beneficiaries you designate. We all need a general power of attorney that says who can make financial business type decisions for you if you're alive but you're disabled. And we all need medical directives that say who can make decisions for us for healthcare purposes, if we're not able to make our own decisions. So those are basic documents that everybody in this room, everybody in the city really needs. Most of the people though in this room probably need more than that. Because as you get some assets, then you care more about where your assets are going. Your financial picture is a little bit more complicated. And so we start thinking about, well, if my spouse and I pass away, do we want our kids to inherit at age 18? Or would we rather delay their access to or control over inheritance to age 25 or 30 or 35? Do we want to use trusts for our kids beyond an age for asset protection or estate tax savings? Do I need to think about maybe a trust for my spouse? Maybe it's a second marriage or a blended family, and so you've got different dynamics that need to be addressed. Maybe somebody in the family has a special needs child, and you want to make sure that assets are available to care for them, but not kick them off of government need-based programs that might provide really valuable health insurance, living arrangements, that kind of thing. So every situation is unique. Sometimes I'll sit down and meet with a client and we go through and they really are kind of the Cleaver family. You know, everything's very vanilla, everything's very simple, and that's great. That's not a whole lot of families these days. And so then we're talking about, well, what's unique to your family, or what keeps you up at night? What should we be thinking about? And then how do we plan to accomplish that?
Very good.
Can you talk a little bit about keeping the money in trust? So let's just say stereotypical family, goes to the kids. I think a lot of hang up that I see people with is, do you leave it in trust? Do you make a kid the trustee? Do you make a kid the trustee at some point? Or do you pay it out of trust at an attained age of X, Y, Z? Can you just talk a little bit about that when you're talking about
I think the answer to all those questions is yes.
Yes.
Right. So we do all of those things. So a very common distribution scheme is after husband and wife have passed away, money goes to the kids in equal shares, and they get a third at 25, a third at 30, and a third at 35. And I think there's a lot about that scheme that makes sense. You know, you don't have access to money while you're in school, so you're going to go to class, you're going to graduate and get a job. Then you're turning 25, maybe you're buying a house, and you get a distribution from your trust. And then you turn age 30, and maybe you're buying into a business, starting your own business, and so you starting a family, you get a second distribution, and then by age 35, you're probably about as mature as we're gonna be, and so you get that final distribution. And so I think that makes a lot of sense for a lot of people. You hear me talk about asset protection. I talked a little bit about an irrevocable trust that prevents creditors from getting the assets into that trust. If you leave assets to your child in a trust that ends at a designated age 35, once they hit age 35, that trust disappears. They get full access to the money that was in their trust, and now creditors also have a shot at that. Maybe they go through a nasty divorce at age 36, and those assets are up for discussion. Maybe they, commit malpractice or have a driving issue, and now the creditor's coming after those assets. That kind of a situation, maybe they commit malpractice at 32, and the creditor sees, well, if I sit around and wait for 3 years, I'll get to collect on their trust fund. And so, so an age-based termination makes a lot of sense, but it doesn't cover every situation. And so if you are sensitive to the asset protection, and a trust that lasts for your child's whole lifetime provides much stronger asset protection against marital divorce risk, against judgment creditors. And so sometimes clients will say, well, I don't like the idea of my child never getting their inheritance. It's going to be tied up in trust a whole lifetime. And so if you feel good about your child having control over inheritance, but you like the asset protection that a lifetime trust provides, then kind of the sweet spot is to let a child become their own trustee, kind of give them the keys to the kingdom, if you will, at a designated age, so that they can be the trustee, they can run their trust, they can take distributions as appropriate, they've got control over what you left to them, but a creditor can't reach into the trust and take those assets out.
And can they eventually in turn kind of set up a trust for their kids of whatever might be left to kind of keep that?
Yes, a lot of times we'll build in a provision that lets a child basically reallocate their trust, maybe among their children, or among the family, or sometimes among anybody that they choose. So they have control over the distribution of their death, but we've got a default provision that they have to exercise to change.
Is this a GST?
Yes.
Yeah, okay.
Yep. So a lot of times we'll call that a GST. Generation skipping transfer is what GST stands for. A lot of confusion, but it has to do with where the tax gets allocated. It skips a child's generation, but the child still has access to it. So it's kind of like, where does the tax ultimately land? And you can skip multiple generations if you have enough money, and what's enough is different for everybody. But if you have enough money, you can put it in trust for your child, and they can eat out of that trust, and then when they die, they can leave it to their children, your grandchildren, and they can eat out of that trust their lifetimes, and then they can leave it to their great-grandchildren, and you can leave it on down the line. And that's really a great way to protect generational wealth and create quite a legacy for multiple generations.
Dan, I want to ask you, on the legal side, contracts, I know that's a big part of your practice. What are some of the kind of hot button issues right now in contracts, things you're seeing, issues you're seeing in recent contracts? I know it's kind of out of left field question.
No, we're just talking about employment or?
Yeah, employment contract.
So, there's maybe two different things to talk about. One are sort of your large sort of health system contracts that are oftentimes forms, and then you have your small practice contracts. Let me focus on the health system first, and I'll talk about the others. I think, like I mentioned in the initial comments, I think one of the biggest issues that I'm seeing is when hospitals are bringing physicians in is around guaranteed salary for a certain period of time. Physicians that are coming into a health system and they're specialists, they've just been through training, whatever it might be, they want to have a guarantee for X period of time, right? I want 3 years that I know, no matter what the patient base is, no matter what your market is, that if I'm ramping up my practice, I don't want to be on an eat what you kill model from day one, because that's too much risk for me, it's too much risk for my family. I want 2 years, I want 3 years. And that's a lot of back and forth that I see at the beginning of the sort of a LOI stage for an employment agreement negotiation. And oftentimes we find is we'll get to some sort of middle ground where maybe we'll settle at 2 years, and then thereafter we'll get an eat what you kill completely. Maybe it's a work RVU productivity kind of model where you're paid on personally performed services and a certain amount for that, or it's some hybrid thereafter, right? That maybe the next year you'll go 50% guaranteed and the rest is above and beyond what you're earning for your services. So that's a big issue. I don't see it as much, I guess, in the small practice because you have a little bit less to play with there, and oftentimes the owner doctor will have a model that he or she has already built, and it's going to be that, right? And I don't have much to, you're here, I'm bringing you in, I can only pay you what you earn because I've got so much overhead, I got to pay for the EHR, I got to pay for all these things. It is what it is, right? Maybe I'll give you a little bit of guarantee during that first year, but beyond that, I can't do it. So that's a big one that I'm seeing. Another is non-competes. I know we've kind of already talked about this. Health systems don't like negotiating that for obvious reasons, one of which is they want to, particularly if it's a large health system, want to treat everybody the same. And so what I've seen a lot of good health systems do is actually get with doctor committees and in their form, try to get a fair non-compete, right? Something that everybody can live with and say, okay, we're gonna, this is what we're gonna impose on everybody that comes in, limit it to just your specialty, maybe something like that, so you can go out and also maybe have some sort of carve out where, you're if you're with a health system, maybe you can go out and hang your own shingle in town if you leave employment with the health system, but you sure can't go across the street and take your specialty to our competitor, hospital. So the non-compete is a big issue, but I don't see it negotiated nearly as much as the compensation at the health system level, just because I think there's this fairness concept, which makes a ton of sense, right? That you don't want to be giving somebody 25 miles and the next person comes in and, oh no, you're 50 because we think whatever, right? Whereas sort of the opposite with the small physician practice, I actually do see that negotiated quite a bit, where somebody comes in and they want to keep them away from your competitor if they leave. I see often the owner doctor or doctors giving more on that than on the comp piece for whatever reason. I just see that as much more negotiable in that context than in the large health system. I'll mention one more. I did say this before, that the termination provision is huge. I had a husband and wife who were going way across the country, and they were really worried about the ability of this system to terminate their contract. And for good reason, right? When you're moving, picking up and leaving, you want to know that you're there for some period of time. And so the system was kind of like, well, we need this, what if it doesn't work out? Oh, okay, fine, but what if you just decide this is a bad business decision we made? Well, we've up and left, we're 2 time zones away from where we used to be. We've relocated our kids, we're new schools, all those things. I want a couple years here to get this thing going. Give it to us, right? So that's something that I see a lot too, and it's very circumstantial, right? Everybody's kind of got different feelings on their level of, we talked a lot about risk in that regard. But I do try to encourage the physician clients, the dentist clients, whoever might be joining the practice or system, to think about what if it doesn't go well, because everybody's kind of got the rose-colored glasses on at the beginning, and for good reason, right? You're excited, it seems like a good opportunity, you got recruited, et cetera, and that's great, but it doesn't always work out, and you got to think what if, and that's a big thing I tell people. So those are kind of the big 3 I'd say that I think about. Other hot button issues. Talked about insurance, I guess. I'm just trying to think if there's others that. I'll say one other thing about compensation is value-based compensation now. We've got a lot of, and it comes more in the sophisticated health systems, but I will say in a lot of physician practices now, particularly in specialties, that are signing these contracts with value-based care entities. And a lot of you are probably familiar with this and how this is all playing out, where you're paid based on quality, and we're going away from the fixed fee kind of model, right? And so that's starting to get built into compensation models. But it's getting there, but it's slow going. And so we've seen, for example, in hospital contracts where maybe $50,000 will be at risk on the back end for meeting certain quality measures that aren't necessarily tied to referrals, but it's tied to your outcomes or tied to meeting certain standards for how we operate our department, right? You're meeting these service line goals, you're meeting these service line objectives or standards, right? You're practicing a certain way so we can standardize care across the network and really streamline things so that everybody's kind of looking at the same thing. And you'll get paid on that, right? And the government has opened up through the Stark Law and kickback changes in the last couple of years for the ability to pay on that, where you really weren't able to do that before. So now that we're getting into this more value-based system, as doctors kind of look for those kinds of changes, and it trickles down from the insurer all the way then down to the employee, because the insurer is going to start paying on quality somewhat. So the doctor's got to get their the system or the employer's got to get themselves aligned and their employees aligned with thinking that way, because that's how they're getting paid. So if the employee's not thinking that way, they're going to be in trouble. So that's another thing to think about as you, and that's going to just keep happening with new contracts. You're going to start seeing that, I think, more and more.
Very good.
Yeah.
Somebody mentioned private equity earlier, and I don't really have a specific question, just kind of a general topic, private equity. It seems like it would be more in your boat than anybody else up there, but any comments on that? Any downsides to it? Do these companies go looking for you, or you go look for them?
Doctors or me as a lawyer?
No.
So,
Like
you as a,
as a
yeah.
physician.
No, do you want?
No, not a medical.
They'll call. They'll
Don't
call.
call.
Yeah, I mean, we
So if I
have.
haven't received a call yet, I'm not That's just saying.
You're under the radar. No, I mean, they are active now, and I can tell you, in your
Everybody's talking about it.
in your specialty plastics, they are very active right now. I mean, that's sort of a new wave that's happening, but I've been reading quite a bit about this, and it's an interesting proposition for people that are considering it. I mean, they're definitely giving up some amount of their income to take some amount of cash or liquidity on the front end, with promises of support and whatever sort of leverage that larger entity could provide them. But it is a big question, because there's just not a lot of history yet of how these are going.
And we're starting to put together spreadsheets of, if you stay in private practice and keep earning as you are, if you take this deal, you can count on the money you're getting on the front end. You can't count on the money they're saying.
Absolutely, yeah.
You're holding out for something down the road. I can't really speak to medical, but I can speak to dental as far as.
It's probably the same.
Yeah, but everybody thinks they can start their own DSO these days. It's not that easy, and there's a lot that are being set up that don't have the management structure intact.
Right.
Because their whole plan is to flip this thing as soon as
Yeah.
they can. So there are people out there now that specialize in representing practices that want to sell the DSOs. And so the DSOs used to think, oh, we can come cherry pick who we want, but it's turning to where if you're a general dentist and you want to take a look at that, you can go out and shop your practice to DSOs. There are people that do that. And not only that, they know they can I mean, I have one guy that I just email him or call him and say, I've got a client being wooed by this outfit, and he'll immediately know how good they are, what their long-term viability is, if they've overextended themselves already. And there's like John said, this is it's still a new thing. I mean, DSO has been around about 15 years, but it's still such a new landscape.
But the private equity presence is really new.
Well, yeah, that's right.
Yeah.
So it's just
What's DSO?
dental service organization.
Yeah.
And
It's
so
been a lot more
it's
common in
corporate
dental
industry. It's
space
like
than-
pharma or
yeah,
something like that.
yeah.
But it's just, the single owner doctor has more options now, and you can be told by one that your EBIT is not high enough. You can be told by another one that we really want you because you're what we're looking for. You can make it clear to the first person that comes after you that they're not the only person that you have to, you're not their only choice.
I mean, it can be a really great financial opportunity
It just
for a
depends what you
practitioner,
want.
but the devil's in the details. And really, to his point, you may like the group that is pursuing you, but to his point, they may flip you over to another owner in 5 years, because that's the private equity's vested interest, is to get out of their investment at some multiple from their initial investment. So
And we've seen
do you
some
know
big
who that will
ones,
be?
the,
That is
Oh,
the risk.
yeah.
So closer to retirement, when that's less of a concern, it's much more attractive. But for someone that's, maybe 15, 20 years left in practice or more, the numbers can be really attractive, but there's a lot of unknown that comes with it. So, we're gathering info on this right now because plastics and other specialties they're out there. It's happening in our industry, frankly, and the
It's
devil's
happening
in the
in accounting.
details. In accounting too. There is this idea of scale, and let's lump them together and we'll sell them to somebody else. And it's worked very well for some firms, and it has worked horribly for others.
As
because of
consumers, would you say
execution.
it's worked well for us for pharmacy?
Right, true,
I don't think so.
yeah.
And I think it changes that dynamic incredibly. Like if you're gonna be there for another 30 years,
Yeah.
20 years, however long, like you gotta go there every day.
Yeah.
But it is part of the market.
But the private
It's here to
equity,
stay.
you're in good fields.
But it's
because
not gonna
the
take
Private
over.
equity's there because they see the opportunity, the
Yeah.
recurrence of income, and the margins within the businesses. But you just have to be very, very careful. Yeah.
I haven't talked to anybody that loves working for private equity.
I was gonna say, that was one thing we
Nothing
talked
will
about.
change until.
When you take their money, you have to do what they tell you.
Yeah.
Treat your patients the
That's
way
right.
they tell you.
Yeah.
Well,
it's a
you're,
very-
you're in a pot of people who have sold 30, 50% of the revenue. So how motivated are all these people?
That's the real issue.
To really bump their EBITDA, which is what
Yeah.
the whole thing is made off of. So you're gonna get an illustration, and we had to do the math on you giving up this portion of your revenue and hopefully, having a better taxation on it in the future. But you're also gonna get a projection of, okay, and then we're gonna get a second sale once we roll you up with all these other groups, and that can happen or not.
Yeah.
It's,
And that's a good point. If you're a top performer in your field
Mhm.
and you're jumping into this pool with other practitioners, you really sort of set yourself at the average of those practitioners. So how strong is the pool? And if they're attracting people that are at the end of their career, they may be great practitioners, but their ambitions are quite a bit different now. And are they really looking to grow their practice? And so you end up with this sort of middling performing pool of practitioners.
Which is why we're starting to see more startups.
Yeah, yeah,
Like
exactly.
there's not a practice for sale, then I'm just gonna start and go compete against this.
Yeah. Well, it is 7:30. This is what our planned time to sort of wrap this up. Does anyone have any questions before we thank our guests and pour some bourbon?
I have a quick question.
Yes.
Have you all seen, at least in the dental field, a lot of compensation as buy-in? In like merging with practices, or not really like the new graduate, but more so like, taking on a doctor that might relocate, that's leaving a DSO, they've got some,
And giving them a percentage of the practice for
Right.
coming on board?
as compensation.
I think Jared would be-
Over time.
Not really.
It's just not in the dental.
I'm not saying it's not out there, I just haven't seen that really. Because if you're a single owner and first thing you want to feel, you don't really want to talk about ownership with your associate until you know that that's what you want to do.
Right.
Now, we do see phasing of buying in, but typically, once that buy-in starts, we consider that associate a 50% owner. They just owe that, because if you go to the bank and get the money and pay the doctor, you pay them. If you owner finance it,
Yeah.
you can say, oh, you're at 10%, 20%, 30%, but ultimately, it's easiest again, it goes back to multi-S corp ownership and all that, just to say 50-50 and do some shifting of income.
I have a good friend who gave 50% ownership to an associate who was gonna go start under a new roof. And I said, don't do it. And they're happy 3 years later. So, that's like, he called it the Japanese model. He's like, we're doing a handshake deal and I've got the right person and I'm investing in them here, but you would probably say no. But people are doing it.
He obviously knew, he had faith in this
Yeah,
guy, maybe
yeah.
they knew each other
Yeah.
and knew his clinical skills. And
Yeah.
Better date before you get married.
Exactly.
Right. Just once you sign a deal to buy into a practice or sell part, it's a lot of unwinding. And I know we're ready to drink bourbon, but real quick, one thing, and I've had this happen twice in the last year, and I haven't had it my whole career. 2-doctor practice, one of the doctors just decides they just want to walk away.
Sure.
Nothing has been spelled out in the partnership agreement on how to handle that. It's disastrous.
Yikes.
Yeah.
Any other questions? All right, well, I just want to thank all of you all for coming. I think this has been great, and really appreciate you all coming out because I know you all have very busy schedules, and so it's really nice to see the room is full. This is a little bit of an example of how we do work with clients for the prospects that are in the room. We are very quick to tell you when this is not our area of expertise, and so we lean heavily on our professional network, which we've spent a lot of time developing over the years. We quarterback all day long, and we love working with great professionals like these gentlemen here. So I think that is, and they do the same thing. You know, I mean, if we refer business to them and they find that it's an area that maybe there's someone better in their firm or in the community to help out, they're quick to do that. It results in the best long-term solution for the client. So thank you all.